Well, broadly, we believe focusing on risk is really critical to delivering consistent, smooth returns for our clients. For us, risk is inherently multidimensional, and so we take a diversified approach that assesses risk from three key perspectives. The first focuses on risks to the global macroeconomy, the second on market sentiment, and the last really focuses on valuation risk. We think all three will be important in the months ahead. From a macro perspective, we think the case for risky assets is supportive. Global growth, which had slowed down significantly from its highs in early 2018, is now showing signs of stabilization around potential. Our global growth nowcaster, which covers over 80% of the world's GDP, does not point to an imminent recession. We think this is also consistent with the Federal Reserve in the US holding their forecast for US growth steady during their June meeting. At the same time, inflation is not really a concern, and that's given central banks the room to adjust their rhetoric and in some cases their policy to help continue supporting the expansion. Sentiment, however, is fragile. The US White House has been a source of uncertainty on global trade, and we're now seeing the impacts of those policies on the actual trade data. We also think that pricing in interest rate markets and to a lesser extent equity markets is a bit too optimistic. On the other hand, market stress is low thanks to central banks, and investor positioning is fairly neutral, which gives room for markets to rally higher from these levels. When it comes to valuations, when we look at them from a cross-asset perspective, there aren't any obvious opportunities that jump out to us. And in particular, traditional equity hedges such as sovereign bonds, Japanese yen, Swiss franc, and gold are all expensive by these measures, which really point to the need of being thoughtful about managing risk. Well, we're positive on developed world equities due to the supportive growth picture and central bank pivot. But importantly, we've implemented hedges to protect against a significant equity sell-off coming from, for example, a trade war escalation. We're also broadly positive on credit because we see a very low likelihood of recession anytime soon, and credit indices offer attractive yields. Finally, we're fairly neutral on sovereign nominal bonds, as we see cross currents roughly offsetting each other. On the one hand, you've got low inflation pressures and accommodative central banks, but on the other, you've got very high valuations and a fairly supportive growth picture.